Every day you're told to watch prices. Inflation numbers, stock charts, housing values, interest rates, market indices flashing red or green. We're trained to believe that these numbers tell the real story of wealth. But here's the mystery no one asks. What if prices are just the distraction? What if, while the public stares at charts and headlines, real wealth is moving somewhere else quietly, systematically, and almost invisibly? Because throughout history, during every major economic shift, collapse, or recovery, the same strange pattern appears. Most people focus on prices. A small minority focuses on ownership. Ownership always tells a very different story. Today, we're uncovering the hidden ledger, the one that doesn't show up on news tickers, doesn't trend on social media, and doesn't care whether markets go up or down. It's the ledger where real wealth moves, while everyone else watches prices. Section 1, Setting the Stage. The illusion of price-based wealth. Modern economics teaches a simple lesson. If prices go up, you're richer. If prices go down, you're poorer. But this assumption hides a fatal flaw. Prices are temporary. Ownership is permanent. You can inflate the price of an asset without changing who controls it. You can collapse markets without changing who ends up owning what remains. And throughout history, the biggest transfers of wealth didn't happen through price appreciation. They happened through ownership reallocation, often during moments of chaos, when the public was distracted by volatility. To see how this hidden ledger emerged, we need to go back to when money itself began to separate appearance from reality. Section 2, The Origins. When accounting became power in early economies, wealth was visible: land, livestock, gold, stored grain. Ownership was physical and obvious. But as trade expanded and finance became more complex, wealth started being recorded instead of held. Ledgers replaced vaults, claims replaced possession, contracts replaced assets. This was revolutionary, because once wealth could be represented on paper, it could also be leveraged, reassigned, securitized. Delayed hidden banks became the guardians of these ledgers. Governments became dependent on them. A new form of wealth emerged, not based on what you owned, but on what others owed you. Debt instruments, equity stakes, interest-bearing claims, rights to future cash flows. This is when the two economies split: the visible economy, where prices fluctuate; the hidden economy, where ownership quietly shifts. Most people lived in the visible one. Power accumulated in the hidden one. Section 3, The Rise. How the hidden ledger went global. The 20th century accelerated this divide. As industrial economies grew, ownership became fragmented. Shares replaced factories, bonds replaced treasuries, derivatives replaced direct risk. Financial markets exploded, not to serve production, but to trade claims on production. After World War II, global institutions formalized this structure. The Bretton Woods system didn't just manage currencies, it standardized accounting of international claims. Nations stopped settling trade imbalances with gold. They settled them with IOUs. This created a massive global ledger of obligations. Held these claims: central banks, commercial banks, sovereign wealth funds. Institutional investors who owed them, governments, corporations, households. From this point on, the real question wasn't how much money exists. It was who sits on which side of the ledger. And that ledger was never public. Section 4, The Breaking Point. When money lost meaning, but ledgers didn't in 1971, when the dollar was severed from gold, money lost its anchor. But the ledgers remained. In fact, they became more powerful than ever. Currencies could now expand endlessly. Prices could inflate or deflate. But debts didn't disappear. They compounded. This is where the illusion deepened. People saw prices rising and assumed wealth was increasing. But behind the scenes, debt obligations grew faster than income's. Asset ownership, concentrated interest claims, expanded. Financial leverage multiplied. The hidden ledger ballooned. By the time financial crises started appearing regularly, 1987, 1997, 2000, 2008, the system was primed for massive wealth reallocation. And every crisis followed the same script. Section 5, The Fallout. How wealth moves during crisis. When a crisis hits, the visible economy panics. Prices fall. Markets crash. Headlines scream, but the hidden ledger goes to work. Here's what actually happens. Step 1. Liquidity dries up. Those without cash are forced to sell assets. Step 2. Prices collapse, assets trade below intrinsic value. Step 3. Debt remains. Loans don't disappear just because prices fall. Step 4. Capital steps in institutions with access to cheap money buy distressed assets. Step 5. Ownership shifts, not temporarily, permanently. This is how. Homes move from families to funds, companies move from founders to creditors, land moves from communities to investors, infrastructure moves from states to private owners. By the time prices recover, ownership has changed hands. The public celebrates the recovery. The ledger shows who actually won. Section 6. Failed fixes. WHY. Price-based solutions never work after every crisis. Policymakers focus on prices, stimulate demand, support markets, stabilize inflation, boost asset values. But none of these address ownership. Rising prices don't help if you no longer own the asset. Inflation doesn't protect you if your wages lag. Market recoveries don't matter if claims on future income have already been sold. Price-focused fixes stabilize appearances while cementing structural shifts in the ledger. That's why inequality widens after every crisis, even when markets recover. The system isn't broken. It's working exactly as designed. Section 7. Modern parallels. The ledger today. Look at the world right now. Global debt exceeds $315 trillion. Asset managers control tens of trillions in capital. Central banks own massive portions of sovereign debt. Corporations buy back shares instead of investing in wages. Housing increasingly owned by institutional investors. Meanwhile, wages stagnate, savings erode. Purchasing power declines, prices fluctuate wildly. The public debates inflation numbers. But the real action happens elsewhere. Who owns housing? Who controls infrastructure? Who holds government debt? Who claims future cash flows? This is the hidden ledger, and it rarely moves in favor of those watching prices. Section 8. The pattern. Why the same playbook always wins. Across centuries and systems, the same pattern repeats. Expand credit, inflate prices, trigger instability, force liquidation. Consolidate ownership, reset prices. Each cycle transfers wealth upward. Not through theft, not through conspiracy, through structure. Those closest to money creation and credit survive volatility. Those dependent on wages and prices do not. 3 takeaways. 1. Prices are signals, not substance. They fluctuate, but ownership defines power. 2. Wealth moves during crises, not recoveries. By the time prices stabilize, the ledger has already changed. 3. The most important economy is the one you don't see. The hidden ledger decides who controls the future. Final warning: as long as people focus on prices instead of ownership, the same transfers will continue. Crises will feel shocking. Recoveries will feel reassuring. But the underlying distribution of wealth will quietly shift further out of reach. The real danger isn't volatility. It's invisibility. Because when you don't see the ledger, you don't realize what you're losing. Call to action if you want to understand how real wealth actually moves and why watching prices isn't enough. Like, subscribe, and turn on notifications. Because the next transfer won't be announced. It will be recorded quietly on the ledger you were never meant to see.